What do we think? As a globe, as a consumer, America, Western civilization, stock market, commercial growth, AI, data centers, supply, beaches, RVs, boats, airplanes, jet fuel, diesel fuel, economies. Fossil fuel is something we all need. Whether you want to hug a tree or whether you want to go start your big combustible engine, we all use some type of fossil fuel every single day. The question becomes, what's a fair price? The question becomes, is $85 a fair price or is $55 a crude oil barrel a fair price? And what I want to tell you, or I want to say today is, be careful what you ask for. Sometimes people want something they really don't understand the residual side effects of what they want. Prime example, crude oil prices. Oil prices jumped up over the last 120 days because the Iranian war, north of $110 a barrel, sent every country on the planet in absolute chaos, anticipating what if the Strait of Hormuz and the war between the United States and Iran last, and the supply disruption cannot be overcome by alternative energy sources and crude oil suppliers around the globe. And what if oil prices stay over $100 a barrel for the foreseeable future? And that's the new norm. That is cataclysmic based on the responses. It would be cataclysmic to so many different economies around the globe. Now, here we are today saying, wait a minute, and I hear this all the time on Fox News and from all the so-called financial experts, don't worry, oil prices are going to go back below 70, could even go down to $40 or $50 a barrel. Well, I hear a lot of cheering in the audience. I hear a lot of people very happy about the price of gasoline at the pump, jet fuel, diesel fuel, all kinds of logistics, manufacturing, production, everybody that needs a byproduct, refined byproduct from a raw barrel of oil, whether it be domestically produced here in the United States or whether it be coming in from one of our producers around the world. Everyone is cheering cheaper oil prices. What they forget, though, is oil prices and the oil and gas industry is no different than farming. It's no different than any other business. If the professionals, the careers, the experts, the geologists, the geophysicists, the CFOs, the landmen, if all those intellectual parties within the oil and gas industry say, you know what, we've been working really hard, and the buyers, the consumers believe we are working and making too much money, and they're not going to pay us that much anymore. They're going to pay us sub $60 a barrel, sub $50 a barrel. Well, there's a multitude of side effects that take place whenever crude oil prices get to a certain level. I've seen it over my 41-year career. So you say, can they make money at $60 a barrel? Yes, we can. Can we make money at sub $50 a barrel? Yes, we can. What we do is we begin to do like you do when you find out you have bills and expenses, but the cost of living has gone up. Maybe you don't subscribe to Netflix. Maybe you cancel one of your cars by selling it. Maybe you don't go out to eat as much. Maybe you don't travel as much. You don't take as much vacation. Well, the oil industry does the same thing. We simply cut out secondary costs, non-important costs. What are part of those costs? Well, we don't build new pipelines. We don't build new right-of-ways. We don't build new refineries. We don't pick up new crude oil terminals. We don't build new drilling rigs. We don't fill a yard full of pump jacks and tanks. What we do is like you do. We say, if you're going to pay us the bare minimum to be in the oil and gas business, but yet 100% of every single day of the year, you need to use and consume that barrel that we deliver, but the market says we're not going to pay you more than $45, $50, $60 a barrel, then what we will not do is we will not invest our own money in growth. We will not spend $1 beyond just maintaining our business to the best of our financial capabilities. Now, I want you to think, whether you're a intellectual finance expert or whether you're a business expert or whether you're a college student or whether you're just somebody that's trying to figure out the price of gasoline in your car for your road trip in the month of July. There is a very strong potential that oil prices are going to go one of two ways over the next 60 days. Now, I said last week I would expect oil price to spike in the middle to latter part of July. I still believe that. That is purely supply driven. That is product deficiency as a result of the soft barrels that have been dumped on the market the last 120 days running out of storage, out of pipelines, out of Cushing, Oklahoma. All these massive storage facilities around the globe have been depleted. If that Strait of Hormuz is not opened up and we don't get that 10 to 15 million barrels coming back to the Strait on a daily, regular basis, you're going to see a massive hunger for supplies in the short term, which could drive that price to $125 a barrel or more. The flip side is, if there are other producers, the UAE, Saudi Arabia, Argentina, Guyana, Africa, Russia, if there are other producers who can make up that 13 million barrel shortfall by adding a 500,000, 1,000,000 barrels, and maybe it's only 4 out of the 13 million barrels, maybe it's 8 out of the 13 million barrels, it's going to soften the blow, it'll lessen the spike, and it'll prolong the actual deficiency of supply on a global basis. So what could really happen by August or September as we see this potential MOU being worked out by the president? It could be, as I said, a true reality, falling off a cliff where you hit a brick and say, we don't have enough oil. And the trader's going to have to pay whatever price they have to pay to get that last remaining oil that's not being put in the market because the Strait of Hormuz is shut down, even partially. Or the flip side is the Strait is opened up to some degree. It's moving 4 or 5 million barrels a day. Other sources have made up the differential. And now all of a sudden we have demand destruction. We have a slowdown in economies because this high rise in the price of oil has caused other countries' economies to slow down. And maybe just a slight reduction in demand globally equals that slight increase in production because the Strait is partially open. And now we have an equilibrium and or an oversupply on a short-term basis. If that's true, you might be looking at the price of oil going as low as $45 a barrel. 45, 125, or somewhere in between. Everybody has to make a decision. Everybody has to decide. I like to figure out and predict where oil prices are going. Today, I don't have enough information. I don't know what the decision is going to be made by those in charge of the war. I don't know what continues to have the escalations right after an MOU is signed. Here's what I do know. Fundamentally, economically, today, we have a true discord between what is being supplied and actual consumption. And you can go dip in your savings account all day long and throw 1.5 billion barrels into the market until everybody's kumbaya, everything is A-okay. But the truth of the matter is, even those soft barrels will eventually have to be produced and put back into those storage, Cushing, Oklahoma, pipelines, refineries. They've got to get back to the position they were before the war. So somewhere in the near future, we've got to put back that 1.5 billion barrels that we use in soft barrels in the market to make this market what I would call at least a normalized market with some form of equilibrium. You can say what you want, but crude oil prices are going to move very heavily over the next 3 to 6 months. And it doesn't take much to move them. It takes very simple anticipation and perception by the market. For me, I'm leaning more toward a spike in the end of July because I think it's going to be affected based on the actual supply itself, physical barrels, not trading barrels. I also believe sometime in the next 90 to 180 days, I fully believe that it could be a situation of temporary oversupply if the Strait of Hormuz can be somewhat credible in terms of not having military action, having some kind of consistency more than 1 or 2 days at a time of oil being moved out of the Strait of Hormuz. And if that begins to start to seep into the market, you could see an oversupply between now and Christmas over the last 6 months of this year, and that could temporarily push oil sub $50 a barrel. That's what I think the extremes are. Sub 50, higher than 120, somewhere in between. I believe we'll end the year averaging about $85 to $90 a barrel the last 6 months of the year.